So then sorry for that. I was on a network issue. So as I was saying, I said capital allowance is granted in replacement for what? For depreciation that we normally make provision for under our financial accounting. So as a result of that, so under taxation, capital allowance will be used as what? As a replacement for what? For depreciation that you have what? Under your financial accounting. So in essence, whenever you see depreciation, it is usually what? A disallowable expenses. So what are the features of this capital allowance? It is calculated using standardized statutory rate. As I said, so one of the canon of taxation is that there should be uniformity. So there's going to be what? A uniform rate, a standardized rate that will be applicable to what? To all taxpayers. So the method of application is uniform and consistent to all taxpayers. The same way will be adopted in calculating what allowance that will be claimable by what? Every taxpayer. Equal amounts will be claimed by different taxpayers, provided that the asset acquired were acquired on the same day and under the same circumstances, which follow what the principle of what? Of that was equity. Then the cost and date of use and other related are expected to be the same. So that is what, if you have the same thing, so it will be what? The same rate. The same set of rules apply to all taxpayers. So those are the features. So what you need to know under this capital, you need to know what are the conditions for granting capital allowance. So before a capital allowance can be granted, so what are the conditions that must be available? So one of them is that expenditure must have been incurred on an asset. So you must have what? You must have used what? Use your resources or your money to what? To acquire an asset. Then number two, the asset must be what? A qualified capital expenditure. So it is called assets that will qualify for capital allowance claim are called what? Qualifying capital expenditure. So they call those assets qualifying capital expenditure. So there are those assets that will qualify for what? For capital allowance claim. So such assets are called what? Qualifying capital expenditure. Then the asset must be owned by the taxpayer. For you to say you want to claim capital allowance on an asset, the ownership of the asset must not be the owner of the assets. The asset must be say what? You are going to what? Claim what? Capital allowance on that asset. It must not be an asset that what you went to borrow. So the only time that you can claim capital allowance on an asset that you are yet to be the owner is what? If you are buying an asset on what? On hire purchase, the law also gives you a right to claim the capital allowance. You know, hire purchase is an agreement whereby what? Ownership, so the ownership of the asset is transferred to the buyer until upon what? Upon the payment of what? Of the last installment. So under hire purchase is a process whereby what? Payment is made on an instrumental basis. So before you make the final payment, you are not yet the owner of that asset. It is until when you make the final payment that you become the owner of the asset. But for capital allowance claim, because you are going to use that asset for the purpose of your business, the law gave you a right. When you buy an asset, acquire an asset on hire purchase, you can also claim capital allowance on that. So that is what. So a situation whereby you may not be yet be the owner of the asset, but you may also be entitled to the capital allowance claim. Then the asset must be in existence and in use at the end of the year of assessment under review. So the assets must be an asset that is seen, that is available, not an imaginary asset. Not that you are imagining that in next year we are going to buy an asset. Because you have planned to buy the asset next year. You have already made provision that you want to start claiming capital allowance. No, it's not what? It's not allowed. It must be what? Asset that is in existence and what? You must be using it for what? For the purpose of what? Of that business. So in essence, that now tells you that any asset that is disposed of in any year of assessment, take note of this. Any asset that is disposed of in any year of assessment will not qualify for capital allowance claim. So any asset that is disposed of in any year of assessment will not qualify for capital allowance claim. So where you dispose an asset for capital allowance claim, that asset will not be what? Available for capital allowance claim. Unless you are otherwise told by the examiner that what you should also claim, so that what you should also what provide one, you should also claim the capital allowance in the year of disposal. But where an asset is disposed in that year, capital allowance will not be available for claim on that particular asset. Then the asset must be rent for the purpose of the business. That is, the asset must be wholly, reasonably, necessarily, and exclusively used for the purpose of the trade, business, profession that is generating income that will be subject to tax. So for you to say you want to claim the capital allowance, it must not be what a personal asset that you are using for your own personal benefit. It must be what asset that is what wholly, reasonably, necessarily, and exclusively utilized for the purpose of the business. So for the capital allowance to become claimable. Then also, where you buy an asset, before now, the tax authority, so there is what we call a certificate of acceptance, which is usually issued by the Inspectorate Department of the Federal Ministry of Trade, Trade, Commerce, and Industry. So this particular certificate is to show that truly the taxpayer has acquired that asset for the purpose of the business. The law requires that when you are incurring an amount that is 500,000 naira and above, you are expected to get certificate of acceptance from where? From Inspectorate Department, a department under Federal Ministry of Trade, Commerce, and Industry. So that certificate will show that you have that particular asset in your custody. So it is not difficult to get. You just write to the relevant tax authority for the purpose of acquiring the certificate. So you write to the Federal Ministry of Trade, Commerce, and Industry. So this certificate now is what you are now going to present to the relevant tax authority for the purpose of what? For the purpose of claim of what? Of the capital allowance. Also, a written application must be made to the relevant tax authority. The tax authority, they don't know you. They don't know whether you have an asset or not. So by the time you have gotten the certificate, you now present the certificate to the relevant tax authority to show that you have acquired those assets. So in practice, what is usually applicable is that during the process of filing return by the taxpayer, by the time the taxpayer wants to file return, the taxpayer is going to include the newly acquired asset as part of the asset is going to file by including the certificate of acceptance, by including the certificate of acceptance as part of the return that will be filed to the relevant tax authority, depending on the taxpayer, whether to the FIRS, which is now the NIRS, and to the State Internal Revenue Service. So those are the conditions that must be available for granting capital allowance. And these conditions are very important. It is testable. The examiner can ask you to mention some of the conditions for granting capital allowance. So let us try and familiarize ourselves with those conditions for granting capital allowance. So when an organization wants to acquire qualifying capital expenditure, this qualifying capital expenditure will not be acquired at once. They are not going to acquire this qualifying capital expenditure at once because you don't expect, the organization is not going to have the money. So acquisition of QC, qualifying capital expenditure, will be based on what? On the availability of fund. So that tells you that the capital allowance claim also will not come at once. It will come as much as when you are purchasing when you are acquiring the qualifying capital expenditure. So in essence, that means there is need for you to also look at what the basis period that you are going to apply for the purpose of what capital allowance computation and what an asset allocation. So please, for asset allocation, that is for you to allocate the asset to the respective year of assessment. So you are going to need what? You are going to need the basis period for assessable profits. So before you can say, okay, this asset will be available for capital allowance in a particular year, you go in line with what? With the basis period that you determine for what? For assessable profit. So basically, because now, as we all know that what the Finance Act, the introduction of the Finance Act has eliminated the occurrence of what? Overlapping and gap in between what? The basis period. We don't have what? The issue of what? Overlapping and gap in basis period now. So basically, when you have those questions as what? As a separate individual question, you may not have what? The occurrence of overlapping and gap. You can only have either overlapping or gap when the three scenario of what? Abnormal basis period are combined together. But when you have a question that relates only to what? Only to commencement, a question that relates to cessation, and a question that relates to only change in accounting day, you will not have what is called overlapping and gap, because the Finance Act has eliminated the occurrence of gap. So what that means now is that the basis period you now determine for the purpose of assessable profit will also be used for what? For asset allocation. So any basis period that you determine forward for the assessable profit will be used forward for the purpose of what? Allocating the assets. So what do we mean by that? So let me just analyze that. Assuming we have a basis period, let's say we have tax year. So we have this tax year. So let's say we have a tax year, then I have the basis period. So I mean I have a tax year, let's say we have 2020, in which we know if the accounting year of this assuming the accounting year of this particular tax year is 31st December, the basis period will be 1/1/2019 to 31/12/2019 on preceding year basis. So let's say you are now told that a QCE motor vehicle was acquired on 4th December 2019. So the implication of this is that what? This motor vehicle that was acquired will be available for capital allowance claim from 2020 year of assessment. How do we know that? This motor vehicle was acquired on 4 December 2019. You now go to the basis period that you determine for assessable profit. This basis period now. This basis period, you can see that we can get this 4 December in this basis period. Because this period is part of this basis period. So this asset that was acquired on this date will be available for what? For capital allowance claim in this year of assessment, irrespective of whether it was acquired at the end of the month or towards the end of the last month. So this basis period will be used for what? For the computation of what? Capital allowance. But when you are allocating it, you are going to use the date of acquisition to allocate based on what? Based on the basis period for what? For the computation of what? Of the capital allowance. So that is what? If you have what? The capital allowance that was acquired. So the knowledge of the basis period will guide you to know what? To know when to introduce the capital, to introduce the qualifying capital expenditure for what? For capital allowance claim. But you may still have a scenario whereby you can have overlapping and gap in between the basis period. That is where you are given a question that is having the three scenarios of abnormal profit combined together. The three scenarios of abnormal basis period combined together. Who can remind us, what are the three scenarios of abnormal basis period? What are the three scenarios we have under abnormal basis period? I need somebody to remind us the three scenarios we have under abnormal basis period. Hello? Three scenarios we have under abnormal basis period. I need somebody to respond to that. The three scenarios we have under abnormal basis period.
So let me try, sir. I think it's...
Olani, you want to try? Okay.
Yes, sir. I think it's commencement day. Cessation
Yes.
period
Commencement, cessation, and what? Change in
and
accounting
change in
date.
accounting date.
Changing accounting days. Yes, thank you. So you are right. So the three scenarios of abnormal basis period are what? Commencement, cessation, and what? Change in accounting date. So when these three scenarios, you may have a question that is going to have these three scenarios combined together in a single question. When these three scenarios are combined together, there may also be what? The occurrence of what? Overlapping and gap in the basis period. When these three scenarios are combined together, you may have the occurrence of overlapping and gap in the basis period. So where you have that scenario, where you have that situation, so you have to what? You have to apply the principle as requested by the law. So the law is that where there is overlapping of basis period. So let me analyze it. So where there is overlapping of basis period. So where there is overlapping of basis period, so the period where you have the overlapping of basis period, so the period that is common will be located to the year. So what that means is that when you a question that is having an overlapping of basis period, overlapping of basis period is simply mean common basis period. So it is going to, because you cannot say, okay, that asset was acquired in those 2 years. You have to pick a single year. So by law, it is what it is deemed that what you allocate that asset, that qualifying capital expenditure to what? To the earlier tax year. That is the tax year that comes first. So if, for example, so let us look at example, e.g., let me say example, we have a 2020, in which the basis period will be 1/1/2019 for a company that's for a tax year that is adopting 31st December to 31/12/2019. When you now get to 1, because of whether change of account in accounting day or some other reason. So the basis period you have for 20 is now giving you 1/10/2019 to 31/12/20 to 31/12/2020. Then 22. We have 1/1/2021 to 31/12/2022. So let's say we have a scenario like this. So the overlapping period, overlapping period simply between 1/10/2019 to 31/12/2019. Why? If you look at this period that I call overlapping period, you can find that period in the year 2020. And you can also find it in what? In year 2021. Because that period is what? Is available in more than 1 year of assessment. It is called overlapping of basis period. And when you have a scenario like that, it is assumed. So for capital allowance, for asset allocation for capital allowance computation, you are going to allocate the what? The qualifying capital expenditure to what? To the earlier year of assessment. Let's say, for example, so assuming, for example, motor vehicle, e.g., a motor vehicle was acquired. A motor vehicle was acquired on 1/11/2019. If the law did not tell us to what, to allocate it to the earlier tax year, there is going to be confusion between the what? Between the taxpayer and the tax authority. Because the taxpayer may say you want to allocate it to 2020, while the tax authority may be what? May be saying they are going to accept 2021, which is going to be what? Bring dispute between the taxpayer and the tax authority. So as a result of that, so when this occur, you can see that this 1/11/2019, you can find it both in 2020 and 2021 year of assessment. The law now says that when you have a situation like that, for capital allowance computation, you are going to allocate it to what? To the earlier tax year. So this period now, so this asset, this motor vehicle will be assumed, will now be what? Available for capital allowance claim from 2020 year of assessment. So do we get that? It will be available for capital allowance claim from 2020 year of assessment. Instead of, apart from overlapping, you can also have gap in basis period. So where you have gap in basis period, if it is the period of gap, the law says that the period of gap should be allocated to the later tax, should be allocated to the later tax. Yes. So what do we mean by this gap? Let's say we have a question like this. We have an narrow like this, 1/1/2019 to 31/12/2019. Then when I have 2021, that is now giving me 1 to 31/12/2020. We also have 2022, which is 1/1/2021 to 31/12/2021. If you look at this period, these three illustrations, you can see that between gap is between 1/1/2020 to 31/3/2020. If you look at this from January 2020 to March 2020, you cannot find that basis period in between these 3 years of assessment. So because you cannot find it, it is called what? Gap in basis period. So where you have a scenario like this, you can also have a scenario like this where you have the 3 situations combined together. When you have a scenario like this, it's expected that the period of gap should be what? Should be allocated to what? To the later what? To the later basis period. So if you now buy an asset now, so let's say an asset, a motor vehicle was acquired on 31/1/2020. So this motor vehicle that was acquired on 31/1/2020. So the law now says that it should be allocated to the later tax year. So you are going to say what? So that period where you are, this period, so this asset has now acquired on 31 January 2020, which is the period of gap, will be allocated to the later, which it will be allocated to 2021 year of assessment. So it will be allocated to 2021 year of assessment. So that's what they mean by what? Gap or overlapping in basis period. So any question? Any question?
Sorry, sir.
Okay.
The gap aspect of it,
Okay.
I'm still having an issue with. I didn't understand how you get that. And the overlapping, both
An issue
the
like
gap and overlapping.
what we mean by gap is, okay, you look at this date now, 1/1/2019 to 31/12/2019. When is this next one supposed to start?
It's supposed to start 1/1/2020.
2020. You can have a
Yes.
scenario that instead of starting from 1/1/2020, maybe because of change in accounting dates or because of some other unforeseen circumstances or some other information according to adjustment that you have to make when you are doing your computation of accessible profit. It's not starting from that date. It's starting from 1/4/2020. So that means from between January and March, it was omitted completely. From where? From the basis period. So as a result of that, that period that was omitted is called what? It's called gap in what? In basis period. Simple illustration for gap is what? Omission. So when you omit a period, it's called what? It's called what? Over gap in basis period. So that period that was omitted is called what? Gap in basis period. So because that period cannot be found, any asset, that does not mean that the taxpayer will not purchase assets in that period, because they work during that period. Any asset that was acquired during that period, it is because of computation of tax liability based on how the tax is being computed that makes you to have that occurrence of gap. So any asset that is bought in between that period of gap will be allocated to the later. So you know that period is between 2020 and 2021. Between 2020 and 2020, which one is the later? Is 2021. So it will be assumed that the asset was acquired in 2021 year of assessment. So any other question?
Oh, no, sir. Thank you, sir.
Any question? Then that is how to. So that tells you that for the purpose of computation of what? Of capital allowance. So you need what? A sound and good knowledge of what? Of computation of what? Of accessible profits. So what are now the types of capital allowance that are available? So we have various types of capital allowance, which as well, some of these types of capital allowance has been abolished by what? By the new tax law, by the NTA. But because your exam still focus on what? On the old tax law, we are still going to what? Treat what? Information relating to what? To the old tax law. So what are now the types of what? Capital allowance that you have? So the first category of capital allowance you can have is called what? Initial allowance, which is written as what? IA, initial allowance. So initial allowance, they call it initial allowance, IA. So as the name implies, initial, it is granted once in the lifespan of an asset. So you are going to claim it only once in the lifespan of an asset. It is claimable only once in the lifespan of an asset. It is claimable only once in the lifespan of an asset. So that is for initial allowance. It's claimable only once in the lifespan of an asset. So it is claimable at the beginning of the useful life of the assets. You are going to claim the capital allowance, the name is initial allowance. Then it is granted in full, irrespective of the number of months in the basis period. I said it earlier that your basis period will assist you in what? In the computation of capital allowance. So you may have a basis period that is having lesser than 12 months, or a basis period that is having more than 12 months. So you are going to grant it for a period of 12 months, irrespective of the number of months you have in the basis period. Then you have it is utilized to arrive at the tax written down value. You know, we said this is a relief that is given to provide for wear and tear of the asset, like depreciation. So after removing the capital allowance from the cost of the asset, what you arrive at is what is called the tax written down value, which is the carrying amount as you have it under your financial accounting, that carrying amount that you always talk about. So which is the cost. So your tax written down value, tax written down value is equal to cost minus initial allowance. So we give you the tax written down value, which is the carrying amount of that asset after you have claimed you have claimed the capital allowance. So you are going to utilize. So you are going to utilize the what? You can't hear me. Somebody sent a message that you can't hear me. Can you hear me now?
Can hear you, sir.
Okay, because I can see someone sending a message. So it's going to be utilized in what? In the computation of.
Sir, before you go to that tax written down value,
Okay.
we're not hearing you. So we didn't know how you arrive at that tax written down value.
Okay. So what I mentioned was that tax written down value is the value you arrived at after you have provided for the wear and tear of the asset, like your depreciation. You know, under your depreciation, when you remove your depreciation from your cost, you have what is called what? The carrying amount, or the what? The value of the asset afterwards, after the depreciation. For tax purpose, you have what? Tax written down value. After you have claimed the relief, initial year. So the value of your asset is what is called what? The tax written down value. So after you have claimed what you have used at the beginning of the year, at the beginning of of the useful life. So which I now said to arrive at the tax written down value is simply what? Cost minus what? Initial allowance. So you wanted to ask a question?
Okay. So when we
So
when we deduct the initial allowance from the
yes,
cost, we now have
that will
our
give you
cost written down value.
no, not cost written, tax written down value. Tax written
Tax,
down,
writ- tax
tax
written down
written
value.
down value. Yeah, you have tax written down value as that. Then this initial allowance is calculated as what? On a straight line basis, which is calculated as cost multiplied by what? The tax rate. I made mention when we started earlier that capital allowance is granted at a uniform rate. So the rate is what? Is the same for all category of taxpayer in order to allow for equity. So it's provided at a uniform rate. So because it is provided at a uniform rate, so it is what? That rate, you just multiply the rate by what? By the cost of the asset to get what? The value for the initial. And note, it is not what? It is not prorated. Then any unabsorbed amount in any year can be carried forward indefinitely until also provided the taxpayer is what? Is in business. So he has a right to what? To carry what? To carry forward what? The initial allowance that because that is available in any year of assessment. Because you may have a scenario whereby the accessible profit that is available may not be enough to what? To claim the relief. So as a result of that, any balance not claimed in any year can be carried forward to subsequent year, and so on and so forth indefinitely. So until what? Until the taxpayer has what? Has money to what? To claim the allowance. So that is for what? Initial allowance. So after initial allowance, we have the next one, which is what? Annual allowance. So this annual allowance possesses the following what? The following features. Annual allowance. It is written as what? AA, annual allowance. So it is, as the name implies, annual. You are going to, it is granted throughout the lifespan of the asset. So it's granted throughout the lifespan of the asset. You are going to be claiming it from the beginning of introducing the asset up to the end of the useful life of the asset. It is granted throughout the lifespan of the asset. It is calculated on straight line basis. Then it is prorated according to the number of months in the basis period. So this one now is usually prorated. If the number of months in basis period is not up to 12 months, so you are going to prorate it according to number of months in the basis period. Then it is also used to what? To determine the tax written down value. The same way we have, so that means our tax written down value will now simply be what? Cost minus initial allowance minus annual allowance will give us a tax written down value. So tax written down value will be the cost minus initial allowance minus annual allowance will give us what? The tax written down value. So then also it is what? It is deducted to arrive at any unabsorbed amount can be carried forward indefinitely. Also, like on initial allowance, if you are unable to claim any amount in any year of ourselves, you have a right to carry forward, so as far as well, up to what? Up to and so on and so forth. So how is this what? How is this annual allowance now calculated? So the calculation depends on what? On the year of assessment. To calculate the annual allowance is calculated as just annual allowance, because I told you that for it's very prorated for the number of months in basis period. They may have a scenario whereby the number of months in the first year may not be up to 12 months due to what? Either commencement of business or change in accounting day. So as a result of that, you may have in the first year, the capital allowance calculated as cost minus initial allowance, cost minus what? Initial allowance divided by cost minus initial allowance divided by n. Divided by n. So we have what's called divided by n. So this, so divided by n. Cost minus initial allowance. So divided by n. Big N. Then multiply by m divided by 12. So that is how to calculate the annual allowance in the first year. So I'm going to tell us the meaning of all those information. Then allowance for subsequent year. For subsequent annual allowance for subsequent year is calculated after the first year, is calculated as written down value divided by tax written down value divided by big N minus small n. Big N minus small n. Or cost minus initial allowance or cost minus or this formula. Or cost minus initial allowance divided by cost minus divided by n. What we mean by this is in the first year where the number of months is not up to 12 months. So you have to look at cost minus initial allowance because you are going to calculate initial allowance firstly. Cost minus initial over n. So this n now is number of years to claim capital allowance. Is number of years to claim number of years to claim capital allowance. And how do we determine that? Let's say the rate of the capital allowance of the annual allowance, let's say annual allowance rate is equal to 25%. It is expected that you should be claiming 25% every year. And you want to claim 100%. If you are claiming 100% and you want to claim 25% every year, so number of years will now be 100 divided by 25. So that will give us the number of years, which is what? Which is 4 years. So that's how to determine the number of years. So you look at the rate of the annual allowance and you want to claim 100. So divide the rate by 100. We give you a number of years. So multiply by M. The M, number of months. How many months? Number of months basis period. How many months do you have in the basis period? We give us all the M that you are talking about. Then in the case of this one, we have tax written down value over tax written down value divided by small divided by big over small n. So which is what? Which is in the case of this. So that tax written down. So you know the meaning of small n, big N already. So our small n, our small will now be number of years. Small n will now be number of years in which annual allowance has already been claimed. So I wrote subsequent year. Let's say the first year, you now have second year, year 2. We are now in year 2. Let's say we are in year 2 now. So annual allowance will simply be cost, written down value. How do you get that? You'll have, in first year, you'll have say cost minus initial allowance minus annual allowance in the first year. Then that will give you the tax written down value, which I explained here earlier, which we have here as this cost minus initial minus annual allowance. We give you tax written down. So you get that tax written down value in year 2 over n, big N, number of years. Let's say this is 4 years. So, you are now in year 2 now. Small n will now be how many years before that year 2? How many years have we claimed that capital allowance? We have only claimed for what? For 1 year. So that is the small n. So that is what the small n. Number of years for which the capital allowance has already been claimed. We give us the small n. And please, this formula, this first formula and this second formula, the adoption of this formula will give you different answer, and it is allowed. You can adopt any of these two formula. You can adopt any of the two formula. You are going to get a different answer when you adopt any of the two formula. But I always advise students to apply this. Reason being that when you apply this, you will need to make an adjustment at the end of what? At the end of the useful life. But when you adopt this, there is no adjustment that you need to make at the end of the useful life. When you adopt this, you need to make adjustment, because if at the beginning of the year, the number of months is not up to 12 months, you need to adjust it when you get to the end of the year for the remaining year. So for examination purpose, please always adopt this formula for the subsequent year of assessment. So that is that under annual allowance. Calculate this annual allowance at the end of the useful life. Let's say this one now, that you are going to claim it for 4 years. It is expected after the 4th year, you should retain at the end of the useful life, at the end of that 4th year, you should retain a value of 10 naira. An amount of 10 naira should be retained as the nominal value of the asset. So it is expected that that asset must have a value at the end of the useful life. So we are going to retain 10 naira as the of the asset of capital expenditure, which we are going to use as the carrying record purpose in your computation. So that is the second category of allowance that is available to taxpayer. After that, number 3, we have export processing zone allowance. So export processing zone allowance. So this is also granted. So granted to on building and plant equipment. Look at that expenditure. If you are incur expenditure on building and plant equipment, building and plant and equipment in a manufacturing nature, in what? In an export processing zone region. If you incur an expenditure on plant, building and equipment for the purpose of manufacturing and for the purpose of exports, you are going to get what is called export processing zone allowance, which is at the rate of what? So that allowance is what? 100%, at the rate of 100% of the cost of the asset. You are going to get 100% that cost at the beginning of the useful life. So that is also what the third category of capital allowance available. Thereafter that, we also have another allowance called investment allowance. So this is available on plant, machinery, and equipment. Take note of that. Investment allowance is granted on on plant, machinery, and equipment. Please, this equipment we are talking about is not office equipment. They are another name for equipment is this big machinery. They are called equipment, not office equipment, not like a computer or so. Those ones you don't use it to manufacture. Equipment that are used to for manufacturing are the one that will qualify for investment allowance. So it's the top 10%. It's granted a rate of 10%. It is the once in the lifespan of the asset, like what? Like our initial allowance. As you are granted the initial allowance, that year also, you also grant investment. If the asset is plant, machinery, and equipment, then it is granted in full. It is granted once in the lifespan of the asset, yeah. It is granted in full, irrespective of the number of basis pay. Even though if the number of months is less than 12 months, you are going to grant the full amount of the of the number of in the basic period. Then we also, it is granted in the first year. I mentioned that earlier. It is not taken into consideration in determining the tax written down value. Yes, this is very important. When you have arrived at your investment allowance, your investment allowance is not used to determine what tax written down value. It is only an annual allowance that you are going to utilize to determine tax written down value. Investment allowance is not utilized to determine what tax written down value. So we are not going to use what investment allowance to determine what tax written down value. So you are going to utilize what investment allowance to determine what the tax written down to determine what the tax rate. You're not going to investment allowance to determine what the tax written down value. So we use what we use only what initial and annual allowance in determining what the tax written down value of the asset. So take note of that. So then if an asset has been granted an investment allowance, there are some conditions that that asset must follow. So investment allowance cannot be claimed, or if already granted, shall be withdrawn. Where you have granted an investment allowance to an asset, and if within 5 years there is any sales of that asset, that investment allowance will be withdrawn by the relevant tax authority, or where the asset is transferred to part of the group. So where you are selling the asset so so where the asset is disposed of, so the asset will not be available for what? For any investment allowance. If it has already been granted, the investment allowance will be withdrawn by the relevant tax authority. If the asset is disposed of within 5 years of what? Of acquisition, then there is any appropriation of the asset for the purpose other than chargeable purpose. So where you're also selling the asset, so where you're also making the asset, you are transferring it. So any sales or transfer of dealing with asset being a case where it appear either. So as I said, where you are selling it to members of your group, that's it, and the transaction is either not as arm's length, or so it will not be what the investment allowance will be withdrawn. But this investment allowance, according to what law, Finance Act 2023 has abolished this investment allowance. The Finance Act 2023, which take effect from first of it take effect from to take effect from 1st of 2023, but it was extended to 1st of September 2023. Finance Act 2023 has abolished this investment allowance. In essence, what that means is that to be vigilant. If you're giving any basis period that is having period, that is having September, in between September 2023, take note of that. A basis that from September 2023. If the taxpayer acquire plant, machinery, and equipment, such will not be available for what? For investment allowance, because of that allowance has been abolished. That so any basis period that is in between the from September 2023 will not be available for what? For investment allowance. So you need to be vigilant with what? With the basis period when you are calculating what? When you are calculating all the capital allowances. So when you are calculating, to be vigilant. They will have so that you don't want to be using the asset again, whereby you decided that you want to so whereby you now decided that what you want to make use of, you want to dispose of the assets, where you decided that you want to dispose of the assets. So what that means is that what, for disposal, that will give rise to either what, or balancing charge or balancing allowance, when there is what, disposal of what, or qualifying capital expenditure. So when there is disposal of qualifying capital expenditure, so give rise to what is called what, balance charge or balancing allowance. So the first one we have is what, balancing charge. So balancing charge is when the sales proceed during the disposal of the qualifying capital expenditure exceed your tax written down value. Don't forget what is tax written down value is what, is tax written down value is arrived at as cost minus initial allowance minus annual allowance. Okay, sorry. So tax written down value so tax written down value. I hope you can see my screen now. Somebody mentioned that they can't see my screen before. Can you see my screen now? Okay.
Yes, sir.
Can we see my screen now? I
Yes,
need
sir.
somebody to respond. Okay. All right. Thank you. So you know that your tax written down value is cost to cost minus initial allowance minus annual allowance. When you now have balancing charge now, balancing charge, BA, will now be when you are disposing the sale, when your sales proceed, that's the amount you are collecting from the disposal minus is greater, is more than when your sales proceed, is more than your tax written down value. So when the sales proceed is more than the tax written down value, you have what is called a balancing charge. So that is what balancing charge. So when the sales proceed is more than the tax written down value, that's what we mean by that is, let's say QCE, a QCE was disposed for 100,000 and tax written value as at date of disposal is 20,000 naira. So what that means is that what your balancing charge will be equal to 100,000 minus 20,000 naira. 100,000 minus 20,000 naira. So that will give us how much? 80,000 naira. So which will be this balancing charge now is what is an additional income. Take note of that. Balancing charge is an additional income that is subject to tax of the taxpayer. Balancing charge is an additional income that is subject to tax in the hand of the taxpayer. And there is a rule guiding what the application of the balancing charge. The rule is that the balancing charge, the total balancing charge that you are going to subject to tax in the hand of the taxpayer must not exceed the total capital allowance already claimed by what by the taxpayer. The balancing charge to be what? To either company income tax or personal income tax must not exceed the total capital allowance that is already claimed by the taxpayer. If any balance will be regarded as what? Chargeable gain, which will be what? Which will be liable to what? Capital gain. So what the law is saying is that what? Amount you are going to recognize as income in exam, we only relate to what? The one that relate to what? What is used to what? To do the business. So that it does not use for the purpose of the business will not be deemed as what? As balancing charge. So take note of that. So the maximum balancing charge will not be greater than what? The total capital allowance granted or claimed on what? On the asset. So any balance will be what? Will be subject to what? Capital gain tax. So after the balancing charge, we also have what? Balancing allowance. This is when what? When the what? When the sales proceed than the tax written down value. So this is an additional capital allowance. So it's like your what? Your initial allowance, your annual allowance. It's also what? An additional capital allowance, which is available when what? When the sales proceed is lesser than what? Than the what? Than the tax. So balancing charge, balancing allowance is when what? When the sales proceed is less than when the sales proceed is less than the tax written down, value, which means that the taxpayer is yet to claim its full capital allowance. So it is a what? An additional capital allowance that is claimable by what? By the taxpayer for what? For the available year of as capital. So those are the capital allowance that are claimable by what? By the tax relevant year of assessment. So those are the capital allowance that are available to taxpayer. So after this, we also have types of qualifying capital expenditure and their rates. Please, these types of qualifying capital expenditure and the rates will be given to you by the examiner. It will be provided to you at the back of your question paper. So you don't need to stress yourself that you want to cram them. You don't need to cram them. Please take note of that. You don't need to cram all these rates that are available for each asset, each qualifying capital expenditure. Because this table will be what? Will be given to you by the examiner at the back of your question paper. What you just need to do is to go to the back of the question paper and look at the qualifying capital expenditure and look for the appropriate rate to be adopted. So you don't have any issue with that. So so we have various allowances and the rate for the initial allowance is a uniform rate that is available to every taxpayer. So any question? Also, when you are buying an asset, it is also expected that you may not buy the asset newly. The asset may be acquired on a second-hand basis. It is possible for the asset to be acquired on second-hand basis, that the asset may not be acquired newly. The asset may be acquired on second-hand basis. So where an asset is acquired on second-hand basis, the following rule will be adopted. According to the tax law, where you are buying an asset on second-hand basis. So according to the tax law, the assets are now grouped into two major forms. The two forms is either the asset is a building or other category of asset. Where the asset is a building, please, where you are buying a building on second-hand basis, no matter where the building is being acquired from, whether you are buying it from a company or from anywhere, that building will not be available for what? Initial allowance. Take note of that. No initial allowance will be claimable on that building. The building will not be available for what? Initial allowance claim. Why? Because for any building acquired on second-hand basis, according to the tax law, will not be available for initial allowance. You are only going to claim annual allowance on that building on the lower of what? Of the original cost of acquisition and the new purchase price. So what that means is that you are going to compare the original cost of acquisition and the new purchase price. Anyone that is lower between the two will be what? Will be the amount you are going to You are going to calculate the annual allowance on. And which will be based on what? On the useful life of the asset. Take note of that. So where buildings are acquired on what? On fairly used, on second-hand basis, it will not be available for what? Initial allowance. Only annual allowance will be claimable on the lower of what? Original cost of acquisition and the new purchase price. After building, for all other category of assets, So that asset, where the asset is acquired on what? On second-hand basis, the asset will be available for both what? Initial and annual allowance, provided that what the transaction is at arm's length. Provided that that transaction is at arm's length. Also, in that case, that asset, the fact that you are buying it on second-hand basis, that you are going to what? You are going to claim both what? Initial allowance and annual allowance. But where you are provided with this condition in the question, that is what? Where you are told that what? The asset is what? The transaction is between what? Related party. That is where a parent company is selling to what? To what? To their subsidiary, where the transaction is between related party. In that case, you are not going to claim initial allowance. So where the transaction is between related party, there will not be what? A claim for what? Initial allowance. You are only going to claim what? Only annual allowance on the what? On the unexpired useful life. Or where you are told that what? That asset is acquired from where? From a business entity. Because it is acquired from a business entity, that means that business will have what? Will have claimed what? Initial allowance on that asset before. You are only going to claim what? Annual allowance on what? On the unexpired useful life. But where you are not told any of this information, and the transaction is not between related party, so, and you are also not told that it's purchased from a former business entity. In that case, the asset, the fact that it was acquired on second-hand basis, it will be available for what? Both what? Initial allowance and what? Annual allowance claim. That is what? Where asset is what? Is acquired on what? On second-hand basis. Then we also have, so the Finance Act also did what is called a categorization of company. According to the Finance Act categorized company into three major forms. We have what? The small company, the medium company, and what? And the large company. So those small company are company with what? Turnover of what? 25 annual turnover. Where your annual turnover, according to the Finance Act, where your annual turnover is what? 25 million naira and below, you are regarded as what? As a small company. Then where your annual turnover is what? Above 25 million naira and less than 100 million naira annually, you are regarded as what? As a medium company. And also where your turnover is what? Annual turnover is 100 million and above, you'll be regarded as what? As a large company. But all these companies are also what? Entitled to what? Capital allowance claim, provided what? They are engaged in what? Business activity. But for small company, because small companies are exempted from tax, any company with turnover of 25 million, according to the Finance Act and below, they are regarded as small and they are exempted from tax, in which their tax rate is 0%. Such company also will not be what? Will not be entitled for what? Capital allowance claim. Because if you are using an asset capital allowance is a relief. If you are not going to pay tax to government, you don't expect government to what? To bring money out from their pocket to what? To give you the relief. So when you are not paying tax, you are not also not going to be entitled to what? To the capital allowance claim. So what that means that small companies are not what? Are not entitled to what? Capital allowance claim during the period that they are what? They are small company. They will only be entitled to what? To capital allowance claim when they move to either a medium company or large company on what? On the unexpired useful life of the assets. So they can only claim capital allowance when they move beyond what? Their small company, and what? It will be on the what? On the unexpired useful life. So when you are told that what? A company is a small company from their turnover, so they are not going to be entitled to what? To capital allowance claim. So they will not have a capital allowance. Then this capital allowance you want to claim. It is not everything that is claimable by the taxpayer. It is usually restricted because government also need money to what? To provide what? For the basic amenity that they want to provide. So this capital allowance is now usually restricted to 66 to 3% of accessible profits. So simply put as what? To third. When you are calculating, it is usually restricted to what? 2/3 of what? Of accessible profit. So any amount that is 2/3 is what you are going to charge in that year. So any balance will be what? Will be carried forward to subsequent year, and so on and so forth. Any balance above for 2/3 will be carried forward to subsequent year, and so on and so forth. But where the company is engaged in what? Manufacturing and agro-allied, where you are told that the company is what? Is engaged in what? Manufacturing and agricultural business. Please, no restriction of what? Of capital allowance. So where the company is engaged in what? Manufacturing and agro-allied business. They are going to claim what? Their capital allowance in full. So also capital allowance is also restricted where there is what? Element of private usage. The asset that you are qualifying capital that you are supposed to be using for the purpose of business, you are using part of it for your work, for private usage. So in that case, you are only going to claim. So that portion that relates to private will not qualify for capital allowance claim. Also, where the basis period is less than 12 months, it will be restricted to the number of months in the basis period. So those are so you restrict it to what? 2/3 of what? Accessible profit, except for what? Manufacturing and what? Agro-allied, which are what? Agricultural business. So under the tax law, we have two categories of income. We have what? Taxable and non-taxable income. So taxable income are income that are liable to tax. While non-taxable income are those income that are what? That are not liable to tax. For example, so example of non-taxable income are interest on what? On government bond or government treasury bond. So when government issue treasury bond, when they pay you interest. So because you are encouraging the government, you are assisting the government to provide fund to them. So no tax will be what? Chargeable on what? On that form of income. Or profit on what? On disposal of what? Of asset. Asset you are supposed to use for the purpose of your business. You are now selling it. Any profit you make from it they are called what? Non-taxable income. So what the Finance Act also brought a rule. That is what Finance Act 2021 also brought a rule that for capital allowance claimable should be only capital allowance that you are only going to claim should only relate to what? Taxable, should only relate to what? Income that is what? Asset that you use to generate taxable income. That is the asset, the qualifying capital expenditure that will qualify for capital allowance must only be those that you are using to generate taxable income. Take note of that. Any asset that you are going to claim capital allowance on must be asset you are what? You are using to generate what? Taxable income. Where any asset relate to what? Non-taxable income. Any asset you are using to generate non-taxable income will not qualify for what? Capital allowance claim. Why? Because you are not going to pay tax on that what? On that income. So government is also telling you that so they are not going to give you what? Any relief as what? As far as that asset is concerned. So capital allowance is only claimable on asset, on taxable asset that are used to generate what? Taxable income. Those that relate to non-taxable income will not be what? Will not be available for capital allowance claim. But however, where the what? Where the non-taxable income does not exceed 20% of the total income. Government look at it that where your non-taxable income is not more than 20% of your total income. So they look at it that amount is insignificant. So they gave you a right. You can claim what? The full relief. Full relief will be granted for the purpose of what? Or for the. So that means where what they are saying is that where the non-taxable income does not exceed 20% of your total income. So you have a right. So government will give you a right to what? To claim capital allowance on what? On both what? On both the what? The asset that you are using to generate both what? Taxable income and non-taxable income. But where it exceeds 20% of your total income, it is only those that you are using to generate what? Taxable income that will be available for capital allowance claim. Then also, it is expected that a company should operate on a going concern basis. But also, where a company is not operating on a going concern. So where a company now decide to cease operation, they may have what? Unrecoup or unclaimed capital allowance as at the last day of cessation. A company that wants to cease operation may have a capital allowance yet to be claimed as at the last day of cessation. So because you have capital allowance yet to be claimed, you don't expect government to give you from their money. So government, the tax law also make what? Available provision for you to recover back that what? That to recover, you have a right to recover back that what? That unrecouped capital allowance as at the date of cessation from your what? From your previous taxable income. So what that means is that what? Where as at the date of cessation, a company, a taxpayer is having what? An unutilized capital allowance. They have a right to look at before that date of cessation. Before the date of cessation. And what are the income that they generate before that date of cessation? They will look back at that income and what? And reclaim back that unabsorbed capital allowance. And when they are looking backward, they have a maximum period of 5 years backward. So they are going to claim back that unutilized capital allowance from their taxable profit backward. They will look at what taxable profit backward for a period of 5 years backward for the purpose of what? Recovering what? The unabsorbed capital allowance. Any amount after the 5th year backward will become lapse. So it is possible that we want to look at back years, which we have already passed. It is possible that for those years, the company has already paid what? Tax to the government. And you now say they should claim it back from those back years. If tax has already been paid for those years that they want to claim back, the company has a right to request for a refund of any amount that is available as a result of what? As a result of the unabsorbed capital allowance. You can see that this provision is available only for capital allowance. But in the case of loss relief, you know that for loss relief, you cannot do anything with it again. The loss becomes a permanent loss. But for capital allowance, you have a right to recover back that amount backward for a maximum period of 5 years from your taxable profit or from your total profit, or in case of the capital allowance. So those are the principles that we need to know under the capital allowance. So before we move to the higher point. And some of these principles have changed. So let me just mention some of them that have changed. So some of the principles, according to the new Tax Act now, it is not everything that you have here that is applicable now. The new Tax Act has abolished what is called initial allowance. So we don't have initial allowance any longer again. In the new tax law, in the Nigerian Tax Act of 2025, there is nothing like initial allowance again. But for the purpose of your exam, you are still concentrating on what? On the old syllabus, in which one you are still going to compute your initial allowance. But the new tax law has eliminated the initial allowance. Also, there's nothing like balancing charge and balancing allowance again. The new tax law has also eliminated that from where? From the computation of capital allowance. This rate has also been changed. So the rate of annual allowance now has now been modified for different capital allowance. So we don't have initial we don't have, so it is not this rate again. So the rate has also been changed. So those are the things that have changed in the new tax laws. But you just need, so I just mentioned that for you to have a knowledge of what is happening in the new tax. So you are not using that for the purpose of your exam. So take note of that. So any question? Any question?
No, sir.
Yes. Okay. Any question? Do we have any question? So there is no question. So this is where we are going to stop the class for today. So next class, we are going to start with the computation aspect of what. So after knowing the principle, we also need to compute. So in our next class, we are going to start with the computation of what? How to compute what? The capital allowance. So that is what we are going to do in our next class. So in the absence of no question, so this is where we are going to stop the class. So have a lovely day ahead. So take care of yourself and thank you.